Alright guys, so today we're going to be talking about Glass-Steagall Act repeal, which there were a couple of repeals, but this is how the U.S. stock market basically turned into a Ponzi scheme of wealth extraction through options targets of options holders, which is pretty much C-level suites and preferred investors and investor groups such as White River, who I've mentioned previously. And I'm going to explain how they do it and the way it used to be done before there was a series of repeals in the 1990s that didn't directly cause the 2008 crash, but it caused a error in data, and that caused decisions to be made in a self-feedback loop that caused stock prices to rise too high and where true value was not met to the price, and there was not enough coverage for default in this environment, which led to the crash. Basically, they were overextended on risk in 2006 to 2008, and even in 2011 is where people got crushed because this feedback loop caused people to make errors in judgment on bad data. So we'll just go ahead to the whiteboard. The current way this works, this is the center of basically cash flow from consumers to investors. This is basically business operations. From here to here. A consumer sees a business that meets a need that they want. They buy this. The business has investors that they must pay back for operating the business. This is debt, equity, whatever have you. Cash flow, at a minimum, must flow from consumer to investor through the business entity, and the business must remain profitable to sustain this. And the investor's primary goal is to get a return on their investments, ROI. A business's primary outcome, if it's a publicly traded entity, must be to return shareholder value. So as it currently stands, business owners hold options, and these investors hold options at certain prices to execute. So what they have to do is, this business C-suite has to get his $100 stock to $110. The business has money available, but there's not enough buyers in the stock market to elevate to his option price. So the business C-suite will agree to execute a buyback of individuals who already own stock. So as the company buys back its shares from the market, the stock price rises from 100 to 110. Once it reaches this 110 price, the C-suite can execute their options, and then they sell and extract the wealth to themselves and their families for improved business operations. But really, the consumer's money here has flown up to buy their own stock back inside the business, to elevate to the option target price of the C-suite, and the stock price artificially rises from 100 to 110 to satisfy the C-suite options. This rising investment appears to cause a return on investment. The investors of White River also have options prices. So as their return on investment rises, White River's stock price rises as well. White River executes its own buybacks to push its own price from 100 to 110 so that their C-suite can execute their options at 110. Once the execution of their C-suite option target has been hit, the money flows back into the investors' bank accounts of their fund. Once the money is back into the investors, they want to repeat this cycle, and they've already established that this business will execute a buyback to meet their C-suites and artificially raise the stock price. So what the investor does is it now, because this function of a circle has occurred will invest more into this business. And because it invests more into this business, the next round of option buybacks will rise again. And the C-suite options will be targeted again and rise artificially again. So this cycle, which is functioning with the series of repeals people commonly refer to as the Glass-Steagall repeals, is how a circular momentum of money is maintained between the business and the investors. And the consumer money is entering the cycle, but very little is being done to improve the process. So this artificial value here, this loop is called a positive feedback loop. It's an artificial value of businesses' value rising based on returns, but not on productivity. While productivity may rise, it is not commensurate to the level of the return on investment of the stock because the feedback loop is occurring. The majority of stocks are currently far overvalued, especially in the S&P 500 due to passive investors who don't care and they're going to buy because unfortunately that is what the majority of Americans do, is put their money in the S&P 500, and they don't understand how passive investing is overcrowded and values of the S&P are distorted, we'll say. So the way this used to work before some dumb president repealed it is this is how it used to function under the Glass-Steagall Act. A consumer's money flow enters the market. It goes to the business. The business must pay its investors back for its debt or its investment. But it cannot, in this system, execute buybacks or own certain financial institutions, and vice versa. So the business provides value to the investors, but without being able to artificially inflate its own asset price of stock, it must develop the business and improve productivity and efficiency. Capital is flowing slower to the investors here. The other flow of capital must go out. The capital goes out to owners of the equity or the asset, and this is done at the stock market, people selling, etc., but it is not the business buying the business back itself. The majority of this will see the capital not be sold if the business is improving. So once the business capital is out, the business must efficiently put the money back to use to return shareholder value. So what it does is it improves in business efficiency and efficacy. And once the business improves efficiency or efficacy, it returns value to the customer. The customer benefits from this, and if they have retained the customer through loyalty or outcomes, the business will receive monetary cash flows in the circular cycle here, in a consumer-based productivity cycle. Here, this is a financial feedback loop. Consumer-based, value, loyalty, retained customer. When you are in this system, it forces the business operations to manage profits and debt more efficiently into the industrial process or even human capital retention. Less extraction can occur. It still does to an extent, but it occurs at less. The speed of capital extraction occurs at a slower rate. The constant aim in this business of return value to the business and the consumer is pretty much acquisitions, process improvement, and reinvestments of research and operations. And the farther you get away from this position here, the more artificial loopback you'll get. And it takes so much momentum to improve this process cycle with physical goods and physical returns and debt remanagement and restructuring due to an outstanding business receiving restructuring its debt under lower interest rates, etc., etc. It is less sensitive to shocks to this system. Under this system, if any piece of the pie is reduced, the C-suite will not make its options. The artificial price will not rise. The investments on the ROI will not rise. The options price of the investor will not rise, which will cause the buyback not to be within range, the options not to be within a buyback influenceable range. So the buyback will not occur because asset prices have not lifted. And so at any point, if this is broken, the artificial value of this feedback loop gets broken. The investors do not reinvest into the business. What we have now is 60% of American households have less than $500. So we're going to see this cash flow into the consumer of the business cycle that causes this feedback loop to slow. And it's going to take some while because you're basically going to lose you're going to lose cash flow, which is going to affect your projections. And projections are fine to an extent, but earnings cannot really be faked. So once you have a miss on earnings in the business because of consumer demand broken, this whole thing breaks. And this business in this cycle on both sides still has this debt repayment to these investors to some degree somewhere. Realistically, the C-suite is only concerned about what they're incentivized to do or reach, which is to meet these buyback options so the people in the C-suite can be paid. So as earnings dip, they can perform last-ditch wealth extractions, like the CEO of Lehman did, to get their last extraction before the cycle stops. People talk a lot about, this is basically how this works. People talk about M2, and M2 is basically money supply. But M2 cannot be given realistically directly to the business. It can be given to a consumer or an investor, and it has to flow here. So you're going to start hearing in the news here soon that M2 and the money supply is down. The money supply is down. You know we got $36 trillion in debt. The money supply is down, and the consumer is weak. They don't care because they have to force dollar bills, however they print them or get them, through this business to keep this cycle running all the way around again. The total money supply matters to a degree in this positive feedback loop, but what really matters more is what's known as the speed of money or the velocity of money, and how fast that money can change between hands. Because if it cannot change between hands fast enough, the loop will also break. And so as the consumer demand dies and the monetary supply becomes insufficient, what you're going to see is that feedback loop get threatened. And the lobbyists are going to talk to Congress, and they're going to want a capital injection to save these essential businesses. And in doing so, they're going to do their best to inject enough money into that feedback loop to restart that engine of that positive feedback loop. But remember, in that non-Glass-Steagall side, the consumer is not inside that loop. So you're going to be left out as that owner-investor's business cycle moves. And I don't blame you for being left out because the majority of households have less than $400. Almost all households have less than $1,000. Well, I think the number's like 78% or something have less than $1,000. So you're not doing. I don't blame you for not being an investor or an owner because you realistically you don't have the capital because you don't have the money to invest. But if the next print comes and we print money to restart the speed of the cycle on the non-Glass-Steagall side, the economy will become divided, and it will become divided like a mountain valley. And on one side of the valley will be those who own little and nothing. And on this valley of people in the middle class, there will be nothing. And on the other side of that mountain will be the owners. And if we don't really start talking about injecting capital, not into consumer bank accounts, but into households, specifically through mortgages, like I was saying in one of the last videos, about 200,000 to mortgage balances. If we have to modify household net free cash flow on a median statistical model, averages are useless because for everyone who's making $100,000, there are 3 people making 35. And when you average their money out, you make the 3 people look like they're making more money. And realistically, I mean, $35,000 people are screwed, but the $100,000 people are still screwed. So yeah, that's how repealing was commonly referred to as the Glass-Steagall repeal, is causing wealth extraction into basically C-suite level individuals, rather than what used to be a better business model of reinvestment into the business and reinvestment into productivity. We're losing the ability to access this, because that valley is going to be a Grand Canyon if this next print occurs and it is not targeted toward relief of households, and specifically to net free cash flow on the median balance of households. So I know I've hinted on this, and I'm sure some of you guys understand this, so hopefully this provides a little bit of clarity. This is like a mini little episode, I suppose, to help explain this stuff. And my next real episode is going to be the flight of capital and the flight of wealth, and explaining how I said that you need to be where you need to be by the end of 2026 due to interest rates declining. You need to be a house that's defendable, that you're going to be in for a long time. And I'm going to explain to you how to find immovable value when you're looking at where you need to be by 2026. Because there are some places you'd almost be better burning your house down and taking the insurance money, because there's no value where the house is and there's no access to capital. So households are becoming liabilities. So I'm going to explain that in my next video about things you need to look for, things you need to look into, and we'll go from there. See you there.